my golden rule is never let the tax tail wag the dog. And what I mean by that is you don't want to do it just for taxes. Like you don't want to buy a bad property and just to get the depreciation. Because one, it's a deferral. So if you mess up and you have to sell it, you have to pay all of it back and at a higher rate. You want the investment to make sense on its own. It's my great pleasure to welcome Thomas Castelli to the show. How are you spending 100 hours and more time than anyone else, especially if you don't live near the property?
Yeah, absolutely. So the first thing is you have to make sure you track it.
What are passive losses and why can't I take passive losses and offset my W-2 income or my capital gains?
Before 1986, you could just take the losses from your rental real estate.
You're a CPA. I'm not a CPA. I'm just, LARPing as someone knowledgeable. So explain in simple terms, what is a short-term tax loophole?
Yeah, absolutely. So when you buy a piece of rental real estate,
Hey everyone, welcome back to S Tier Like the Best. I'm your host, Michael Chang. It's my great pleasure to welcome Thomas Castelli to the show. Thank you for joining us today.
Thanks for having me. It's an honor to be here.
It's an honor to have you on the show. And for folks, if it's your first time here on S Tier Like the Best, we really dedicate the show to making sure that you better invest both your time and your money. And this is specifically geared towards short-term rental operators. But if you are a real estate investor in general, I think a lot of these lessons will apply, especially this episode, where we're going to really dive in on tax. Tax is not something you want to worry about in April of the year. Like if you do the work ahead of time, you can really materially improve your tax situation by one, just learning where the opportunities are. And once you learn those opportunities, how to structure your affairs accordingly so that you can take advantage of legal tax benefits that are available to real estate investors specifically. And real estate really is one of the most tax efficient ways to invest. So we're really looking forward to diving in today on some topics with Thomas. So Thomas, why don't I give you a few minutes if you want to introduce yourself and your firm?
Yeah, absolutely. So my name is Thomas Castelli, and I've been investing in real estate since around 2014, 2015, somewhere around there, and started off as a limited partner. Eventually ended up syndicating a deal with my mentor. So I have active real estate experience. We since exited that deal, and I just kind of stayed more on the LP side, just given the fact that I'm just so busy here at the firm. But here at Whole CPA, we help real estate investors across the United States reduce their tax bills by using the tax code to their advantage. We also help them streamline accounting and of course tax preparation. But long story short, that's what we do. We help people reduce their taxes.
Perfect. Real estate investing is an amazing vehicle for that. And specifically short-term rentals. Me learning how the tax code works for short-term rentals has really materially changed my personal financial situation. I was an investment banker. I was paying 50% in taxes living here in New York City. And I was making a great salary, but I was looking at my take home and I was like, wait a minute, where's half my money? Investing just in the stock market or even candidly as a passive LP wasn't really moving the needle. And, not only I was looking for cash flow, but I was looking for appreciation in my investments as well as looking to reduce my tax liability. And short-term rentals for me was something that really hit the mark for that because I was able to increase my cash flow through my short-term rental business and reduce my taxes by leveraging the tax benefits from investing in short-term rentals. So there's this thing called the short-term tax loophole. And I really hate the word loophole because it's not a loophole. It's just understanding the tax code and utilizing that to reduce your taxes. It's not a loophole. It's actually plainly written. You're a CPA. I'm not a CPA. I'm just, LARPing as one right now, but or LARPing as someone knowledgeable. So why don't you maybe take a minute and explain to my grandma, explain in a simple terms, what is a short-term tax loophole?
Yeah, absolutely. So when you buy a piece of rental real estate, there's an expense called depreciation. It's a non-cash expense that basically reduces your taxable rental income, often creating a loss, despite the fact that you're actually generating positive cash flow in many cases. So the problem is with depreciation, this loss that's generated by depreciation is that for most real estate investors, it's going to be passive. What that means is that it can only offset other passive income, typically rental income. And it's very challenging.
Just pausing there right away. So I think that's where people so passive losses. What are passive losses, and why can't I take passive losses and offset my W-2 income or my capital gains when it in the stock market? Like I bought Nvidia and I made a lot of money. I sold it now. I'm just a tax bill. Why can't I use passive losses to knock that off?
Yeah. So way back in the passive losses, real quick, from stocks and bonds is actually in a separate bucket than the passive losses from real estate. But I'll kind of shed some light on this. So before 1986, you could just take the losses from your rental real estate, use it to offset your W-2 income or your income from another business. No real questions asked. But it became very controversial at that time. A lot of high income earners, doctors, attorneys, and others were basically buying up properties and other tax shelters and using these losses to offset their income, substantial income, without doing much work. And there was some controversy around that. And the Tax Reform Act of 1986 that was passed under Ronald Reagan introduced Section 469 to the tax code. And Section 469 is the passive activity rules. And under the passive activity rules, it states that all activities, income generating activities, are either passive or non-passive. And businesses can be passive or non-passive, whether or not you materially participate. And we'll talk more about that as we get into loophole. But rental real estate is always is passive by default, regardless of how much you materially participate. So when they put this into law, they basically said that your rental losses can only offset other passive income, which is primarily rental income from other sources. And that's just the way they've written it. They wanted to stop this quote unquote abuse of this. And then what happened was in 1994. So at this time, real estate investors started getting people who were full-time in real estate started getting a little annoyed because they're like, why can a doctor, for example, depreciate their x-ray machine against their income from their medical practice? But as a real estate investor, maybe I'm a developer, maybe I'm an agent or I fix and flip. I'm a full-time real estate professional. Why can't I use the losses from my rental properties to offset my income from my real estate business? So long story short, 1994, they introduced the real estate professional status. And the real estate professional status said, if you spend more than 750 hours and more than half your total working time in a real property trade or business, so in other words, you work full-time in real estate, you can take the losses from your rental properties and offset your W-2 or your active business or your non-passive income. And just for the record, also the stock, capital gains, interest, dividends, all of that's non-passive. Even though it might be passive in real life, for the tax code, it's non-passive. So the real estate professional status was put in place to allow real estate investors to do that. But for the rest of us who are not working full-time in real estate effectively, we're unable to use that. We're unable to use those passive losses to offset our W-2 income. So what ends up happening is those losses get suspended and carried forward to future years, unless you can use the short-term rental loophole, as they call it.
And you keep us in suspense. So, okay, now we don't qualify for real estate professional status. Like, a lot of people that are working in short-term rentals, maybe it's not half the time, it's not 750 hours. So what is the quote unquote loophole?
Yeah, absolutely. So around the time all these laws were written, there was a carve out for businesses that met certain criteria. So, for example, if a property had an average period of customer use of 7 days or less, or 30 days or less, and substantial services were provided, which are hotel-like services, daily cleaning, daily meals, things of that nature, then it was not considered a rental activity, and it was considered a business. And this was originally intended for hotels and motels and similar establishments. And so what this means is that if you meet that criteria, 7 days or less, for example, that's the most popular one, then it's a business. So it's not passive by default anymore. So that means if you materially participate, which you could do with one of three tests, and I could get into those three tests, then you can use the losses from that business, your short-term rental business, maybe in this case, to as non-passive to offset your W-2 or your active business income. So that's and it was originally intended for, again, hotels and motels, which is why people call it a loophole. Because what happens is, like, say you're a high income earner, right? And you're out there, you have a job. You could go buy a property in a residential neighborhood, a single family house maybe, and use the losses to offset your W-2 or active business income by using this 7-day or less rule. So while it's not a loophole explicitly, it just wasn't supposed to be used. It's
Yeah.
like the people who wrote that law didn't think in the 80s and 90s that you were going to be able to go do this. You know what I mean? Like back then, think about it, to do a hotel or motel or even an Airbnb or B&B, significant amount more advertising costs and stuff like that.
That's a great history, and I think that's not talked about enough. Like people think loophole, and then we're kind of doing something that is under the table. It's just something that it wasn't intended when they wrote the law, because the technology Airbnb did not exist back in '94 or when they wrote these laws.
Yeah.
But now, as technology changed, and this is where hiring a good CPA, really understanding the tax rules, can be your benefit. It's like, oh well, this situation allows a high income earner, like maybe an investment banker, can buy a property. It can be rent up fewer than 7 days. You don't, and then you satisfy some other rules like the material participation rules, which we won't get too far into. But there are certain things that if you qualify for it, then those passive losses become non-passive, actually, and technically not active, just non-passive. And then you can utilize that to offset your non-passive income, like your W-2 income or other things in your life. Right. So that is like the loophole. So if you're listening, if you're always wondering like where the tax loophole, like go back and listen to this, because that is why it's called the short-term tax loophole. And that's why it's so beneficial for people like me and other short-term rental investors, because there's no other provision in the tax code that would allow us to do something like this.
Right.
It is really the cheat code to real estate investing right now, because everything else, if you're a syndic, if you do invest in a syndication, if you're doing other things in real estate, you aren't able to take advantage of being able to take depreciation offsetting against your active income. Like that's actually the crux of it, taking the passive depreciation and utilizing to offset your active income. There's no other road besides this one little carve out here that wasn't intended. And with the advent of Airbnb and short-term rentals, voila, bridge created. Yeah. And here we are. Thank you for that. I probably was too complicated for my grandma, but I think actually still a very, very good way of framing this conversation. So how do people qualify? So I'll start, right? My golden rule is never let the tax tail wag the dog.
Right.
And what I mean by that is you don't want to do it just for taxes. Like you don't want to buy a bad property and just to get the depreciation, because one, it's a deferral. So if you mess up and you have to sell it, you have to pay all of it back and at a higher rate. You want the investment to make sense on its own. It's a good market, it's in a cash flow to appreciate, whatever your investment criteria is. And the appreciation is just, it's like a nice bonus on top, but it's never the primary reason on buying that. So let's say you bought a great property, it's cash flowing for you, you have a job, you're making money from your job. Now, Thomas, if you could just talk a little bit about just the mechanics of how that works, briefly.
Yeah, absolutely. So how you qualify for it, basically there's two steps. There's two key things here. First, you need to make sure that you meet one of these exceptions to the definition of rental activity. So it's 7 days or average of 7 days or less for the year on your property, or 30 days or less, and you're providing these hotel-like services to your guests. By far, most people go for that 7 days or less from my experience. The second thing is you need to make sure that you're materially participating in the activity. Otherwise, it will still be passive if you don't meet the second part. And to materially participate, there's 7 different ways you can do it, but 3 of them are most relevant to like 95% of people. The first one is going to be you spend more than 500 hours on your short-term rental for the year. The second one's going to be you do substantially all of the work. So you're pretty much a one-person show with very little to no outside help. Or the third one is you spend more than 100 hours and no one other person spends more time than you.
Okay.
And that last one, the third one, is by far the most popular one of the 3 tests.
Hey guys, I hope you're enjoying the episode so far. If you can think about how you found this podcast, maybe it was on TikTok or Instagram, or maybe someone shared it with you. I don't run ads for the show or have any sponsorships. So the only way this grows is through word of mouth. If my podcast is valuable for you in any way, please hit the subscribe button and share this with someone who you think would help their investing journey or business. Thanks a lot, and let's continue on with the episode. So, and I'm glad you talked about that. I'm glad you actually gave the, it's by far the most popular, because there's I don't want to say misconception, and it's kind of hard. I think it's too strong of a word, but um, a lot of people have a full time job and they want to take advantage of the bonus of the short term tax loophole. And the material participation rules are where people get tripped up because that's where I think the IRS has real issues. If you have a full time job, then how are you spending 500 hours? You know, how are you spending more time than anyone, 100 hours and more time than anyone else, especially if you don't live near the property. So for example, if someone cleaning your property every single time, like that person you'll have to prove is doing less work than you.
Yeah.
So maybe just talk about that a little bit because I know that is the path people are taking. Maybe just talk about what do you need to do to qualify for that, and what are some of the common pitfalls?
Yeah, absolutely. So the first thing is you have to make sure you track it. Not only you track your time that you're spending, but also the time other people are spending. And there's a tax court case out there where someone didn't track their time and they lost because they couldn't prove, the tax court did not believe that the other people spent less time than them, and they had no way to prove that they did. So you have to track both your time and other people's time. That's like a pitfall. But the way people do it, right, is they won't have a property manager usually. They'll be the property manager or the primary operator. They'll handle bookings, they'll handle setting up the property, optimizing pricing, doing any major or playing a big role in any major setup of the property. So, getting it furnished, all that stuff. They'll run point on all of that, and that'll be their responsibility. But then, especially if they're remote, they will have cleaners that are on the ground or handymen that are on the ground. They'll handle the cleanups and stuff like that, the turns of the units as guests come and go. And what they'll do there is sometimes I've seen some people rotate out cleaners, right? Because any individual person, so it could be, you could have 5 cleaners, and as long as none of them spend more than time than you, then you're good to go. So that's one way we've seen people do it. Yeah, I mean, that's the primary way. Like if it gets to the point where their cleaner starting to creep up on hours, you can rotate it out. I've seen people hire cleaning companies and require that as part of the contract that they rotate out people. So that's how we see it handled for the most part.
Let me pause there for a moment. Yeah, so this is, guys, this is a gold here. Like this is something that really, if you are thinking about how to qualify for STR tax loophole and you have a full-time job, like Thomas just gave you probably a lot of value there. So to go back and listen to this, because this is something that can really help reduce your taxes. I've also heard a lot of people, people do this and they'll strategically time the investment to close, say in like a November. And so they only have to self-manage for X amount of days because they don't want to do it full time. So just for that tax year, that's another way of doing that. Maybe you want to talk about that a little bit because I've heard that be a strategy people use.
Yeah, people definitely do that, and we still see it to this day, and we've seen it like last year. The way that there's some pitfalls that are definitely watch out for. So a few things. If you're going to do that, if you're going to buy it towards the end of the year, that's great because there's not that much time that you have to let other people operate it. But you have to make sure, that you have at least one period of customer use. You have to have at least one guest. Usually recommended having 2 or as many as possible because you want to show that this wasn't just something you did for tax purposes, right? You did it as a real business. You just happen to buy it and acquire it towards the end of the year and start operating it. Secondly, there's a tax court case that says if you don't have any periods of customer use, so there's no guests, there's no way to tell that you met that requirement. The second thing is when you go into that next year, if you flip it into a long-term rental or you put a property manager on it or something like that, we've not seen it yet, but there's concerns out there between a lot of tax professionals that could be viewed as abuse and that you only really did it that first year for that short period of time just for the tax benefits. Another thing to watch out for is that this does not work if you sign a lease, like a long-term lease at the end of the year, right? So say, for example, you sign an annual lease on December 27th, and that would end the next year. Because the way the tax code is written, the average period of customer use takes into account stays that cross over the year for both years. So if you have someone stay from December 27th to January 2nd, what's that, 4 or 5 days, those 4 or 5 days stays count for each year, for both years. So you have to watch out. Those are some pitfalls. But long story short, you could buy it in November, December, get at least 2 guests in there, okay? Make sure that you have that document. Make sure you could show that there's 2 guests actually live there. Make sure that the guest wasn't a family member. If you rent to a family member, it's going to be considered a personal use day. And personal use days don't count towards the 7 days or less. Don't do arbitrage. So say me and Mike said, oh, we're going to go ahead and we're going to buy a property. Mike, you stay at mine, I stay at yours. We'll pay each other. That doesn't work because there's this part in the tax code that says that if there's an arrangement like that, then that doesn't count. So you have to rent it to an actual third party. Okay. And you can't rent it to somebody under fair market rent either. Otherwise, that's also considered a personal use day. So there's a lot of pitfalls. At the end of the day, if you want to stay above board with it, if you're going to buy at the end of the year, get at least 2 guests, third-party guests, have them pay fair market rent, document your time that you spent on it, document other people's time you spent on it, and try to operate as a short-term rental after that year ends. Again, we have not seen it yet, but there's concerns out there that one day the chickens could come home to roost. You want to show it's an actual short-term rental.
Yeah. I mean, look, this is great advice, right? Like broadly speaking, don't get too cute. I know some people don't get too cute where it's like, you're trying to just get over that line just by the hair, right? It might work, it might not work, but these rules are put in place so that we have some guidelines on how to qualify for these deductions. Like if you're going to buy and operate short-term rental, like really try to operate it. If you have a life event that changes, you have to move, you have kids, you lose your job, whatever it is, or you got a better job, whatever it is, you have that to document that. But I think again, just highlights that this is a very complex topic. It's good to get educated, but it really is important to have a real tax professional that understand these rules and can, show you where your blind spots are, make sure that you're doing everything correctly on a record keeping side so that if anything does happen, you're well prepared to answer any questions that you might get from an IRS audit or request for information. It's really important to make sure you have someone that, not that they're just a CPA or they're good in real estate, but they actually understand short-term rental real estate.
Yeah,
because it's you have a really great brain surgeon, but if you need a knee surgery, like that brain surgery is not going to be a great, they'll probably be okay, but you want to find an orthopedist, right? So you want to find someone specialized in this because there's a lot of nuance here, and the more focused your CPA partner is, the better off that, the better advice you'll get and the better off you'll be. And this kind of segues into one of the topics I wanted to cover was reducing your audit risk, right? So a lot of people here, I actually have a client of mine who's in my mentorship program. She has real estate professional status. Actually, she's a very successful broker here in New York. She owns short-term rentals. She actually operates it herself. Before I worked with her, she didn't have a virtual assistant or things like that. She was really doing everything by herself. But her CPA is kind of old school guy who's like, bonus depreciation, no, we don't want to do any of this stuff because you put yourself at risk. So let's talk about it a little bit. Like that one, I believe is incorrect. Like that's incorrect. That's just not good advice, tax advice.
Yeah.
I think secondly, when the broader question is, even though that's bad tax advice, the thrust of it was right, or the thrust of it was noble, right? That person did not want to increase their client's audit risk, but there's smarter ways to do that. So maybe we can just talk about it a little bit. Like, what are some things that you can do or someone can do to reduce that risk to them? Because people get scared, like, okay, hey, I made all this money, but then I'm going to take this, $400,000 bonus depreciation expense, and the IRS is going to say, hey, what the heck is this? And I'm going to get that letter, and I don't want to deal with that, so I might as well not do it. So let's disabuse people of that idea.
Yeah. So first thing to realize is that bonus depreciation was explicitly put into the tax code. It was around a little earlier than the Tax Cuts and Jobs Act, but it was reinforced and expanded under the Tax Cuts and Jobs Act. It's nothing nefarious. It's very straightforward and like right there, right? So it's like there's nothing wrong with taking it. There's also nothing wrong with taking or using the short-term rental strategy here we're talking about. As long as you're documenting everything correctly, that's going to be the best defense for you, right? If you do ever get audited, you have your time logs showing, hey, I spent this amount of time on the property. I met this requirement. No one else spent more time than me. I have a log of my property's rental 7 days or less. Like having that set up is going to be the first line of defense. That's the first thing. We talked about this a little bit earlier in the show, but there's some people who will, and there's truth to this. So audit rates are lower on partnership tax returns than they are 1040s. You can invest through a partnership, maybe a husband and wife partnership, or you give someone in your family 1% to open up that partnership, and then you have just the K1 from that partnership reported on your personal tax return. That could be another way to help reduce audit risk. Although I will say that audit rates are relatively low across the board in general. So I think it's a lot of overblown concerns in a lot of cases. I think it's just overblown. And to be honest with you, audit rates have increased slightly over the last year or two as the IRS has gotten increased funding from Inflation Reduction Act. That was that bill. But we've seen a few clients get audited for short-term rental loophole, and people come to us from outside of the firm, and we've successfully defended it. And the key to defending those audits, so you don't want to like not take advantage of what's available to you because you're scared of the IRS. That's what the IRS wants. They want to instill fear in you. What you want to do is make sure you're doing everything right, so that when they do come knocking, you just give them everything that you need to show that you actually did it the right way, and then they go, there's nothing they could do.
Exactly.
So I guess just to answer your question, basically at the end of the day, you just want to have all your ducks in a row. You want to document your position thoroughly. You want to make sure you follow the rules correctly. You want to make sure you're not getting too cute. And also, I mean, that's the bulk of it. That's 90% of the battle right there.
Exactly. So just to recap that, right? Like if you're using a property management system or just on Airbnb, whatever online travel platform that you're using, it's pretty easy to figure out what your average length of stay is. So that you should have pretty easily. If you're starting to creep over that length of stay by what some midterm rentals may be, then keep track of that. If you start to kind of get pretty close to 7 days, you might want to reduce, manage your calendar accordingly so that you don't trip that. That's easy. The hard part is the documentation. People get busy, they get lazy, whatever the excuse you have, but like that's something you want to be really mindful of. There's some good software out there, like I personally use, and this is not being, I'm not promoting anything, just what I'm using. Reps Tracker, it's a good, platform that's on the app. You can take screenshots and, whatever way that you want to do, just document it somehow with screenshots, something that like you can show pretty easily. Hey,
right.
On this day, every day I spent this time. This is the work that I've done. Here's the screenshots. There's no one else doing this. I don't have a full-time job. Whatever the case may be, whatever technology that you can use as well, whether it's a property management system that can show that you're answering the questions, or utilizing a separate phone number, or a messaging software that can record, how many text messages you're sending, how much time you're spent on the phone, utilizing that. So it's really easy to show, hey, I made these phone calls. I picked up the phone calls. This is the number. Like for me, for example, I use a software called Dialpad, and I literally just download it at the end of the year, and it shows all the calls that I made, all the text messages that I made. So it's pretty simple. Like, hey, I spent X amount of hours on the phone, and that plus X plus Y plus Z, well past 500 hours on my side. So that's from my personal experience. But just the framing of it is make sure you have these things documented somewhere. Don't do, oh God, I got this letter. Now I have to go back and hunt all my emails and messages and whip out a notebook and start writing this stuff down. Like that is a path of failure.
Right? No, you definitely want to leverage technology, like you said. All those, I heard of all those before. They're all great. You definitely want to leverage those technologies to make sure you document everything, have everything nice, clean, and organized for sure.
Yeah. But that also like have a good tax partner with you, right? There's stuff they can learn. YouTube University is great. There's so much nuance with tax law that gets lost that you just can't communicate, and you need someone. I don't think this is I personally don't think this is a DOI. This is not a TurboTax kind of thing, right? That you want to find someone that actually knowledgeable about this, can dive into your specific situation and figure out like what is the correct path. Because sometimes it might not be the right thing, or you should be doubling down on something, right? But that's something you want to pay for that experience, because it can save you a lot of problems and be a way to accelerate your compounding your net worth. Because if you're not paying 30-40, we're not giving away 30-40 cents of every dollar you earn, or you can take that and reinvest it and pay it down the line, or take advantage of time value of money. It's a really, really powerful way to grow your personal wealth by effectively reducing the taxes that you pay. Another topic, kind of similar to this is so you have these short-term rental assets and people want to start a business, right? Like, oh, get an LLC and do all these things. And I can get all these great tax deductions. I can buy a Rolex and deduct that because I'm going to use that Rolex to tell time on when I need to go to my short-term rental. Is that a valid tax strategy, Thomas?
The deducting a Rolex?
I say that kind of jokingly, but people want to start a business to save taxes. Like, it's not that simple. Let me just talk a little bit about what that means. Like, you start an LLC, that doesn't automatically qualify you for some tax deductions that you wouldn't have gotten if you not had an LLC. Maybe we could talk a little bit about that.
So when you're starting a business, you want to make sure you're going into that business with the motive to generate a profit, to generate revenue, to generate income, not just deduct expenses. That's how you're going to get into trouble, right? Let's just start there. That's like the first bar. A quick way to get audited is if you have on your Schedule C, for example, when you're starting a business, just expenses and no income. That's like a red flag. That's not really a real business, right? So that's the first thing. You want to go into it generating income. Next thing is that expense must be ordinary and necessary for your business. You don't need, like, if you start going out to lavish dinners and stuff like that, where you start, they're just like crazy expenses that probably can get you into hot water if you're audited, because they're just not ordinary and necessary. So that's the first thing. The next thing is something like a Rolex, right? Like some of these deductions you hear about, Rolex is not tax deductible. Clothes are not tax deductible unless they're a uniform that's distinct and you wouldn't really wear it anywhere else, right? Like, I'm just trying to think of something like
how about this? How about a coffee? Go get a coffee, and we're sitting for a meeting and we're getting a coffee. Is that a tax deduction? And what if it's just in the morning? I'm getting a coffee on the way to the office. Does that count?
No, it usually not. So meals, when you're within your tax home, which is typically a 40-mile radius of wherever your business is located, like, so for example, or your home office in some cases, is not going to be tax deductible when it's by yourself. If I were to go meet up with you, Mike, and say we're in New York, we're talking taxes or business, whatever the case is, our coffees would be tax deductible, right? But if it's just me or just you in our home, like in our area, that's not going to be tax deductible. So food by yourself when you're at home and you're in your home area, not going to be tax deductible, has to be with a business associate. Food when you're traveling. So say you were to travel to a conference in Florida, right? Being in New York, that might be, in that case, if it's for business, that would be tax deductible. So that's just kind of how meals work.
Okay. It's funny. You get, like, everyone's like, oh, now my coffee is tax deductible. It's like, oh, not always. So look, I mean, I think, again, kind of back to the point of this is there are a lot of nuances here. Make sure you're getting the right tax advice. I think second, like, this is not just getting an LLC isn't a license to write off a bunch of stuff. Right? You need to actually have a business that is actually generating revenue, that you're getting a 1099. Like, they can see the income coming in and the expenses are reasonable in what you're doing. You know, people like to get really cute on that. I always tell people that the hygiene part is important. Bookkeeping, which, you know, Thomas, I'd love to get your view on, like bookkeeping, having a business banking account, having a business credit card. You know, really, I like to say, like, dividing church and state, right? Like your personal stuff is on the left, your business stuff on the right. Don't commingle them, because that's how you get in trouble.
Yeah, absolutely. So when it comes to, I'm going to hit on the bookkeeping real quick, but I just want to say that having an LLC, right, is important for asset protection, but it doesn't make too much of a difference from a tax perspective in the sense of your ability to take deductions. You can run a business without an LLC, still take deductions. You can run it with an LLC and still take deductions. So like the LLC in and of itself isn't going to make a major factor. So I listen to a lot of investors are here, you know, and people come work with us. Like, oh, I have an LLC, I can deduct expenses. If you open up an LLC, does not open the door necessarily for deductions. But having said that, when it comes to bookkeeping is critical for your business. So it helps you understand not only the financial health of your business, helps you file taxes, but keeps everything nice and neat and organized. So if you are ever audited, you have all that information readily available. It's critical. It's often overlooked. People let it pile up for years, and it's very costly, time consuming, and a whole bunch of other things to actually get it set up. So when you're starting a business, you want to get your bookkeeping down as soon as possible. You could use a program like Xero, use a program like QuickBooks. That's what we typically use. Or you can use like a spreadsheet when you just start out, but soon you want to start getting into a more sophisticated automated system for your situation. Next is business bank accounts. To your point, dividing a church and state, business bank accounts and personal bank accounts. All right, personal expenses go through your personal bank account, your personal credit cards, your personal debit cards, your personal side. You don't want to be paying for personal expenses through your business side because that's how things get commingled. That's how you break corporate veils when you do have an LLC because you're commingling funds. And also, you might be deducting the wrong things, right? So like if you have a business bank account and you know that everything in that business bank account is income from the business and expenses for the business, it makes bookkeeping a whole lot easier because you can link up your bank accounts to your bookkeeping software, and you can set up automations to automatically book certain entries for you and categorize things so that it makes bookkeeping 10 times more efficient and accurate, right?
Totally.
I can't tell you how many times we've seen clients or pre-clients before working with us would send us their hook up their bank accounts to the bookkeeping software, and they'd be running through all sorts of things personally, things that I can't even talk about here on the show, but they run through all sorts of personal things with their account. If you want to take money out of your business account to buy something personal, make a distribution from your business account to your personal account, categorize it as an owner's draw or an owner's draw on your bookkeeping, and go spend the money personally. Just keep it divided.
Yeah.
It helps for so many different reasons.
Yeah, and like I use QuickBooks Online. You can get started like it's like the $25. There's like the low end. I think it's like $25 a month or something. It's
Yeah,
really well worth it. To I mean, one from a tax perspective, just to keep your books clean and make tax time easier. But there's just really like a business point too. You want to actually see what your real revenue and your real expenses are. And if you have a bunch of stuff in there that isn't directly related to business, it makes it very hard to do that. There's nothing more important than, or there's not nothing, but it's of critical importance that you can go back and look at your P&L and see if you're actually making money, one, and you're not managing it just through your bank account. A lot of people do that. It's like, oh, I have more money in my bank account than I did last month. I made money. Like that's not the case. You really want to see where your revenue is and where your expenses are. And secondly, just from a business perspective, you can see, when things get out of whack, very clearly. Like for me, for example, for short-term rentals, like if my electricity bill is now $1,000 a month, and then the last 12 months it's been $500. Like I want to know that, and you just aren't able to see that if it's everything is commingled in a bunch of different places. But if it's on QuickBooks or Xero or whatever software or spreadsheet that you use, like that's how you make money in your business. That's how you avoid mistakes. And the tax part is important, and it's just another benefit of having clean books. So if there's nothing that you take, if there's two things you take away from this conversation, really you leverage the tax code to your benefit. Get once you've reached a certain point, maybe a year of profitability, or you really kind of see that this is going to be a real business for you, like get real professional help. It's not that expensive, and candidly, it's going to save you more in the long run. And two, get bookkeeping as soon as
yeah,
possible. You can hire a bookkeeper. There's inexpensive ones you can find overseas, or you can hire someone. Hire a company here in the U.S. to do it for you. A little more expensive, but you kind of get that personal connection. Those two things are really going to make a big difference in whether you have a successful business or not.
absolutely.
But Thomas, thank you for giving us all this wisdom. This is, I think, one of the best episodes we've done on taxes. You've given us so much value here. For folks that want to learn more about this and learn more about your company and your services, what's the best way to find you?
Yeah, so there's the best way to find me would be going to I actually have a personal website which just has all my links and stuff like that. So www.thomascastelli.com, that would be the best place to go to grab the links for that. But so if you want to request a consultation with our team or something like that, you could head on over there. We actually wrote a book on the short-term rental loophole called Short-Term Rental Tax Secrets, which breaks down everything you need to know about the strategy and answers some of the most frequently asked questions. And you can find that at Short-Term Rental Tax Secrets. It's on Amazon right now, so you could go ahead and just grab that if that's something you're interested in. But those would be the two best ways at this point. I'm also on LinkedIn and social media and all that. You just search me and you'll be able to find me.
Okay. Well, in the show notes, we'll put your personal website on thomascastelli.com, and we'll put the name down of the book. So if you're if you have some time off, definitely a worthwhile read. And when I first learned this back in 2019, I think, I was researching on Twitter and I was reading stuff here and there, and I had to put it all together. And the space has evolved so much now, where it's in a nice kind of ebook for you that you can digest all of this stuff. So it really, for me, it's been, we've been able to buy 7 short-term rentals in the last 4 years, and we could not have done that if we didn't have the benefits of bonus depreciation and the short, being able to take those passive losses into a non-passive and knock that against our non-passive income. That's been a game changer for us. And, I think if you're listening now and you're interested, definitely spend time and get the right people to help you. It can really make a material change in how you manage your finances. Thomas, the last question for me, business is a team sport, and we're never going to get to where we are without people along the way helping us. For you, what's one of the kindest things that someone's done for you along your personal journey that's gotten you to where you are today?
One of the most kindest
things.
Yeah, I mean that's tough. Kindest things. I don't know. Maybe Brandon hiring me here at the firm. I mean, I can't. When I first joined the firm, I didn't have much tax experience, and he took a chance, took a risk. I think it probably paid off in the long run. But yeah, I'd say it's probably the kindest thing, man. Either that or my first mentor, John. He brought me into the behind the scenes look at a real estate syndication, which is something that I would not have had. I had no business being part of that at the time. I was just fresh out of college. But yeah, those two things. I mean, it's kind of crazy how those little things, those inflection points, sometimes have a big impact on someone's career, their life. So I'd say those two things, honestly.
All right. Well, shout out to Brendan Hall and to John Cohen for enabling your journey and you being able to help others now with being better, more tax efficient real estate investors. Thomas, thank you again for your time. I really enjoyed this. Thanks for coming on the show.
Likewise, thanks for having me.
If you found this episode valuable, please make sure you hit the subscribe button so you can get notified when I put out new content on Airbnb investing. And if you want to learn about how to work with me more directly, I have links below on my description. Click on those and let's figure out how I can help you with your Airbnb investing journey.